Welcome to the deep dive. Today we have the blueprint for how a massive financial services ecosystem. We're talking Square and Cash App plans to hit some really aggressive growth targets through 2026 and, well, even beyond.
That's right. And our source material is great. It's a recent Investor Day Q&A session.
Which means we get the direct, unvarnished answers from leadership about their plans and, I think, crucially, what keeps them up at night.
Exactly. We're not looking at the glossy slide deck here. We're going straight to the mechanics. The mission for this deep dive is really to understand the trade-offs.
Right.
How do you drive, say, mid-teens gross profit growth while promising to basically hold the line on headcount? It's a masterclass in using tech for efficiency.
And the beauty of this stuff is that it's not some rehearsed boilerplate.
Yeah.
We're hearing from Jack, Arita, Owen, Nick, all of them.
And they're responding directly to analysts asking some really tough questions about margins and roadmaps for Cash App and Square. It's a rare peek behind the curtain.
And that clarity, I think, brings us to the core tension of this whole thing.
Yeah, the big question, the one investors asked. If you set aside all the external stuff, wars, recessions, things they can't control, what does leadership see as the single biggest internal risk to hitting those 2026 goals?
And the answer was surprisingly simple.
It's pure disciplined execution, much less glamorous than AI or crypto, but that's what it comes down to.
Okay, so let's unpack that. When a company this big puts out that kind of aggressive guidance, how do they actually build that number? What's the methodology?
They laid it out as a structured, a three-layered process. It really helps strip away the mystery of financial forecasting.
Okay, so layer one.
That's the foundation, the solid part. They use real-time trend lines and historical data from their own ecosystem.
So products that are already live, already scaled.
Exactly. This gives them the baseline. It's the most predictable number they can safely, extrapolate forward.
That's the inertia part. So
Yeah.
where do the bets, the ambition, start to come in?
That's layer two. They layer on the portfolio of new initiatives. These are products that are fully engineered, tested, but maybe haven't launched yet or are just starting to roll out.
So known quantities, but just not at scale yet.
High confidence bets, yeah. Stuff they expect to launch in the coming months.
And I'm guessing the third layer is where the real risk is and the real upside.
Absolutely. The third layer is what they call probabilistic weighting. They apply a carefully managed probability percentage to all those new initiatives.
They estimate when they'll launch and
Crucially, how rapidly they will compound growth. It's this weighting that lets them dial the final forecast number up or down. It ensures they have confidence in hitting the guidance floor, while internally they're aiming for a much higher ceiling.
so if that 2026 growth depends on things they're pretty confident about, what specific products are carrying the most weight in the short term?
When they talk about those known growth drivers, two things on the Cash App side really stood out. First is the continued scaling of Cash App Borrow, their lending product. Second is the deep integration of Afterpay with the Cash App card.
And that's not just what they've already done, right?
No, this is the future stuff. They're talking about pre-purchase card integration, so you can use that BNPL financing before you even complete a transaction.
Okay, let's go back to that idea of execution risk. If the planning is so detailed, why is scaling something like Cash App Borrow such a huge internal risk? I mean, lending isn't a new business.
It isn't, but Cash App lending is. Well, it's different. Traditional lending leans on decades of FICO scores, established credit history.
Right.
Cash App is serving a population that often doesn't have that traditional data trail, or their engagement with the app is just too new to have a long history for risk modeling.
So the risk isn't the product, it's the data science behind predicting who's going to default.
Exactly. The risk is that they have to iterate their underwriting and their loss rate models in real time as they scale. The critical need is to measure the ROI, the return on investment weekly, even monthly.
Because if they're off by just a little bit,
If their assumed loss rates are off by even a few basis points, the entire growth model for Borrow is in jeopardy. The execution risk is hitting the ROI targets and controlling the loss rates at the same time. It's a very high-stakes tightrope walk.
that really puts the scale of that risk into perspective. You can have a perfect product, but if the risk modeling is wrong, the product fails.
Financially, yes.
So moving from risk to efficiency. They have this aggressive goal for margin expansion over the next few years. And it seems like the real leverage is in internal efficiency and productivity.
That's the core of the whole strategy. They have two major initiatives here. First, they are functionalizing the company. moving away from silos and shifting people into these integrated squads, working across block ecosystem roadmaps.
Functionalizing sounds a bit like corporate jargon. What does that actually look like for an employee?
It means breaking down the walls between, say, the Square team and the Cash App team. So product, engineering, and risk people are all working together on shared goals.
So no more duplicated effort.
Right. Leadership believes this structure gives them immense urgency and speed. It's about maximizing the impact of the people they already have.
And the centerpiece of all this is technology. They talked about going all in on automation with internal tools, Goose and Builder Block G2. What are those?
The philosophy is simple, but it's really powerful. Automate the company first. They see Goose and BuilderBlock as the operating system for their own internal efficiency. These platforms reduce friction between teams, handling everything from workflow approvals to resource allocation.
So they're making the machine run faster, not just adding more parts to it.
Precisely. The idea is if they can make their own internal processes lightning fast, then they can extend those tools and efficiencies out to their sellers and customers.
And that's the lever that lets them project that mid-teens gross profit growth.
Without the corresponding growth in headcount. Yeah, they're just extracting a much higher revenue yield from their existing staff.
And that investment must lead to some new internal products as well.
It has. They named them MoneyBot, ManagerBot, and BuilderBot. Think of them as specialized AI agents. MoneyBot, for instance, funnels high-priority financial tasks straight to the right product team, bypassing manual reviews.
Cutting the time to action.
Significantly. ManagerBot helps with workflows and HR, and BuilderBot helps engineers prototype and test faster. It's an acceleration engine for the whole pipeline.
I can see the immediate financial implication there. If your engineers can move 3 times faster, your capital efficiency just skyrockets. What about the more traditional cost reviews?
That's happening too. A rigorous review of all non-personnel fixed costs, real estate consulting fees, travel, cloud expenses. But the goal isn't just blanket cuts.
It's reallocation.
Exactly. Funds are being ruthlessly redirected only to categories that provide demonstrable customer returns. Every dollar has to drive impact.
Okay, let's shift over to Cash App. This gets us to that potential contradiction analysts were focused on. The company guides for low single-digit monthly active user growth, MAU growth. But at the same time, their product, rollout lending, crypto, cards, is incredibly aggressive. Why the muted guidance?
That is such a key piece of context for you, the listener. Leadership clarified that the official public MAU number is the highly weighted conservative baseline.
The number they're sure they can hit.
Yes, based on current trends. However, their internal goal, what the teams are actually compensated on and working toward, is to significantly exceed those numbers. They're managing investor expectations while driving the teams like crazy.
So if the baseline is low, what are the big initiatives designed to accelerate MAU and ARPU beyond that safe zone?
The top priority for Cash App is network expansion, just boosting those growth rates. Beyond that, they have 3 specific accelerants.
Yep.
First, they're pushing into multiplayer money features for teens and families. The goal is to onboard entire household networks at once.
That makes perfect sense. Once one person in the family is on, the utility for everyone else goes up exponentially.
Exactly. The second accelerant is this neighborhoods concept. This means leveraging the tens of thousands of existing Square points of sale
The actual stores and restaurants?
as upsell and distribution points for Cash App customers. Imagine getting a Cash App offer specific to the coffee shop you're standing in.
So turning their merchant base into a massive built-in marketing machine for Cash App. That's brilliant.
It's a critical synergy. And the third lever is entirely new product lines that aren't fully baked into that conservative guidance. Things like credit score products, stablecoins, and Cash App for Business.
And the logic is, if they can succeed in juicing the MAU growth, the profit impact will be huge because they're so good at monetization.
That is their superpower. Even when MAU growth was flatter, their ARPU performance, average revenue per user, has been spectacular. They have a proven ability to dramatically grow that number by increasing utility getting users to move more money, borrow more money, invest more money. So if you accelerate the number of users and keep that high monetization rate, the effect on gross profit is just, it's huge. That's financial leverage.
All right, let's switch gears to Square, the seller side of the ecosystem. They're planning a big push-up market, targeting larger merchants, and they're backing it with a huge transformation in their sales force.
It's a huge bet. The target is 300 new sales personnel, a mix of telesales and field sales by the end of 2027. They think this new field sales arm could eventually match the entire scale of their current telesales operation.
So doubling down on direct in-person outreach. Okay, but here's the insight from the source material that just shocked me, and it connects back to that efficiency mandate.
I know which one you mean.
The data on what salespeople actually do all day.
It's stunning. They estimate that currently a full 50% of a salesperson's time is spent on administrative tasks, not selling.
50%. Half their time is paperwork, manually entering data, chasing signatures. That's a colossal loss of what they call net value added.
It is. So the opportunity is to just dramatically increase the NVA per person by slashing that admin load. They have development teams partnered with ops teams with one goal: automate those sales workflows.
And what's the target?
They want to drop that 50% figure down to 30%, then 20%, and the ultimate target is 10%. Gaining back 40% of selling time for every single rep is just exponential leverage.
What's the specific tech barrier right now? Why is the load so high?
They admitted their existing Salesforce system is really desk-based. It's not optimized for mobile field sales. For example, if a rep is driving around targeting specific merchants, the system doesn't have optimal route guidance or smart scheduling.
So the ROI on field sales is, what do they say, primitive?
Primitive, yeah.
Yeah.
Which means the returns could just skyrocket once they bring better tech and data science to that workflow.
And this sales expansion is tied directly to the upmarket and international pushes. What are the numbers there?
Yeah. International MVA merchant value-added growth is running at about 70% year over year. Very hot. And the upmarket strategy is about selling a whole bundle of software with the payments.
Not just a card reader.
No, complex tools that help bigger clients run their whole business. That drives much higher returns.
And they also mentioned the power of getting those high-profile partners, right?
Yes, the network effect. They said direct marketing has diminishing returns, but when a local iconic seller, they mentioned Katz's Deli or Bluestone Lane, chooses Square, it's the best marketing they can get.
It overcomes the misconception that they can't handle scale.
Instantly. It's a strategic win by proxy.
Okay, so we've covered aggressive growth, massive automation, new products. Let's zoom out one last time to the strategic view on margin mix, because all this innovation creates a bit of a financial headache.
It does.
These new areas, Cash App lending, large sellers on Square, they have lower integrated margins than the core business, don't they?
That is the essential trade-off, yes. Newer growth areas inherently have lower margins than their established, super efficient core business.
So how do they reconcile that? Pursuing lower margin ventures while promising overall margin expansion seems counterintuitive.
They were clear that the focus is on dollar variable profit growth, not obsessing over the margin percentage by itself.
So it's about the absolute dollars, not the rate.
Exactly. They want to drive the absolute dollar amount of profit higher, even if the percentage on that new venture is a bit slimmer. The discipline comes in how they scale.
Through that strict fixed cost management we talked about.
Right. By managing the fixed cost base with all that automation and generating high dollar profit from these new lower margin ventures, the cumulative leverage means the company's overall integrated margin profile still expands over time. It's a highly leveraged accumulation strategy.
It is a remarkable plan. It's like they're simultaneously swinging for the fences with high-risk innovation lending, automation, while maintaining this incredibly strict, disciplined execution and cost management.
And that disciplined execution, as we said at the top, is the main internal risk. If they get that right, especially on the lending loss rates and automation, the potential is enormous. And for you, the listener, here's a final provocative thought to chew on.
Go for it.
If the company successfully reduces that administrative burden for its field sales force from 50% all the way down to that target of 10%, think about it. How dramatically might that one efficiency gain accelerate their timeline for reaching scale in every major global market beyond 2027? You're essentially quadrupling the productive capacity of every salesperson you hire.
That reframes the entire discussion on automation. Thank you for guiding us through this incredibly detailed deep dive. We'll see you next time.